A lot of people lost everything during the 2008 crash, but a lot of people don't know why it actually happened. In this video, I'm going to talk about the root cause of the crash and how you can protect yourself from something like this ever happening to you or your family again. What's up, everybody? My name is Derek Alexander, and I know a lot of people lost a lot of money in the 2008 crash. Although myself, I was too young to experience it firsthand, the last thing that you want to ever go through is something like that. And in this video, I'm going to talk about the root causes of how that crash took place and how you can protect yourself from something like that ever happening. So stick around and we're going to get started. First off, just a reminder that none of this is financial advice and any investment has risk, and you should only invest in things that you're willing to lose. This video is just me sharing my own thoughts and experiences about this 2008 crash. The 2008 financial crisis really was a wake-up call for a lot of investors. The housing market crashing actually revealed that even the savvy investors could lose a lot of money if they weren't careful. But a lot of people don't know why this actually happened and how it can be avoided in the future. So what I'm gonna do is break it down into 5 reasons. So for you guys watching, here are the 5 reasons why some people lost almost everything in the 2008 crash. The first reason is that people were investing in the market without really even understanding how the housing market worked at all. In 2008, when the market crashed, it was really stimulated by a lot of FUD, which stands for fear, uncertainty, and doubt. And it creates a series of panic selling where people sell off all of their holdings at huge discounted valuations just to be able to get out of the markets, which normally is really unwise to do unless you absolutely need that money for your immediate future to live. Because this process of panic selling, it causes stocks to drop even further, which is why it's so important long term to have a plan for your investments and not panic when the stock market drops or even takes a larger dip, but know what you're doing for the long term. That's why preparation is so key when it comes to a recession. One way that you really can prepare for a recession is having an emergency fund that you can use in case you lose your job or your income drops. For example, when you look at how the stock market plummeted in 2008, if you had, let's say, 6 months to a year minimum of cash reserves for a rainy day, then no matter what happens, worst comes to worst, you know you can at least afford all of your living expenses until you get back on your feet with a new job or a new business. The second reason that the markets had such a heavy crash was because the banks were giving out loans to people who really couldn't afford those loans. The process that lending companies were using at that time to vet their applicants was incredibly poor. They were essentially just approving anyone who came in with a pulse that wanted to be able to get a house or had a plausible story without really actually looking into that individual's credit scores, finances, or just their overall ability to repay the loans that they were financing in the first place. What this did was lead to many people taking on a lot more debt than they actually could handle, which inevitably caused them to default on those loans when the economy started to go south. There are a lot of things that we can do to avoid this happening in the future, and one is to be more careful about who we actually lend our money to and to only approve applicants who seem like they can actually afford to repay the loans that they're applying for. There are so many indicators to help identify whether someone can actually pay back their loan. Do they have a business? Do they have a job? Are they provided consistent income for years? Do they have stable tax returns? Do they have a history of abusing their credit cards? We can't control the banks, we know this, but we can control our own ability to overfinance on expenses that really aren't going to actually help us propel our own future of where we want to go. That's why it's so important to have discernment and prudence when we're trying to get loans from entities, because a lot of different institutions will do whatever they can to get that money out. The third reason is that during the housing market boom, people were not thinking about their future or a potential crash. See, during this boom, people were so accustomed to the market continuing to rise year after year, a lot of people didn't really open their mind to the idea that there could be lower years to come. What this did was lead many people to lose a lot of money in 2008 because there was no hedging or risk management that was taking place with their own finances. So when the housing market crash actually hit, it caused a huge number of loan products like subprime mortgages and adjustable rate mortgages or collateral debt obligations to completely go belly up and cause a ton of people to lose a lot of money. See, these products, they were all created to fuel the housing market boom and keep that trajectory going. But when the market crashed, they ended up causing a ton of people damage in the first place. This is why, again, it's so important that people prepare now by not taking out loans that are too big in terms of their monthly payments that they actually won't be able to pay off. So not focus on what they can pay off in the future, but what they can handle now. So in my own life, just to give you an example, earlier this year, my wife and I actually really wanted to secure a house because we had a feeling that with the new presidential administration, mortgage rates were going to potentially start rising. So we worked like crazy to find a house, and we finally were able to find a home for around $750,000 at a fixed interest rate of 3.75. Now, it may seem like a lot, a couple of years ago, but what's so wild is that now, today at least, the average interest rate on a mortgage is anywhere from 7 to 8%. So just so you understand what that means, if we tried to get a house right now, we would pay around the same mortgage month to month, but the value of the home that we would be getting is nearly half. So imagine paying the same mortgage as my $750,000 home, only your home is worth $400,000. That is why timing is so important. The fourth reason is that a lot of companies were overvalued. See, because of the dot-com boom that had just happened, a lot of these companies were at really, really high stock evaluations. So people invested in them without really knowing a lot about these actual companies. A perfect example would be Lehman Brothers, which was worth $600 billion in 2007, but when the recession hit in 2008, it went bankrupt and its assets were auctioned off for just $3.8 billion. So that's a crazy evaluation. So imagine someone having money in that and then seeing it get auctioned off. It's a pretty hard wake-up call. So you may ask how something like that happens. It's when people are investing in companies based on their stock prices, but don't do the actual research into these companies and see what the pitfalls may be. See, people are buying shares back and forth just based off of their friend telling them or the markets, but a lot of people don't do due diligence into a company themselves to form their own opinion and trust their instincts. People spend more time believing in the hype and what everyone else is talking about rather than having their own self-awareness to make decisions for themselves and ask really discerning questions. Before I go into number 5, please drop a comment and share one thing that you're doing to prepare for the next financial crash. The fifth reason is because a lot of people believe that the governments are not regulating the markets well enough. To just give you an idea, the housing market crash of 2008 was one of the worst financial disasters known in American history for our economy. It led to millions of dollars in losses for homeowners and investors, and it took years for people to recover from, and some people have still not fully recovered from this crash. Now, while a lot of local businesses were shutting their doors during this time, the government actually bailed out AIG, which is known as one of the most controversial decisions the US government has made in our economy during this period. A lot of people, they do believe that it was necessary to prevent a complete and utter collapse of our entire economy, but a lot of other people believe it was nothing more than a handout to large corporations, basically just getting a pat on the back. Now, regardless of which side a lot of people fall on, there's no denying that the bailout had a huge effect on our own economy. What's really important about this is that it's everyday Americans who really get hit hard when things like this happen. It's normally not the top CEOs or the bankers, they're top people on Wall Street. It's the people that are starting their own business or buying their second house to have another investment property for their family. And that's why it's so important that everyday Americans really educate themselves and do the best that they possibly can to avoid future depressions that may come in the future, so they can make sure that their money is diversified in so many different things instead of just one. And that's why a lot of people may ask, what are the signs if a future recession is coming? How can I be prepared? Well, one thing you got to ask, are there a lot of layoffs happening in different companies or corporations? Mass layoffs going on. Has consumer spending gone down quite a bit? Is there a rise in bankruptcies? Has inflation gone up? Is the normal price of certain things going way higher? These are all little trends that we can use to be able to make sure that we're aware. And in times like this, that's why, in my opinion, I think it's really important to be cash rich, so you're aware of your own financial situation, your expenses that you have coming in, and you're not putting all your money into things that are going to basically just drown your bank account, put you in more debt, and have you in a position where you really don't have the right resources to battle those future bad times that could potentially come. The last thing I want to say is that while some parts of this video may seem doom and gloom, you have to remember that we right now are in the best time of human history. It has never been easier than it is right now today to live life. The certain comforts we have, how accessible things are, we're living in an incredible time in the world. And with that incredible comfort, we have to make sure to continuously put ourselves in uncomfortable situations to callous our mind, to callous our will, and to grow and develop, not just physically, but mentally too, and do that for our family as well. So thank you so much for watching the video. Please give it a like, a subscribe, turn on post notifications, give a comment below, and I'll see you next time. Thank you so much. Bye.